Bryan Schreier at Sequoia, you were one of the first to get in with co-founders Drew and Arash when they started Dropbox back in 2007. How proud are you to watch this portfolio company of yours now go public in one of the biggest tech IPOs in recent years?
Well, it's been a great privilege. We first met Drew and Arash when Dropbox was just an idea, and two tremendous founders with a product vision. And fast forward to today, you have a billion-dollar company built by some of the finest people I think you could ever hope to work with. So it's been a great privilege for us to be involved.
And you've seen kind of the life cycle in the past 10 years. They did take some times where they refocused the business, where they cut costs, where they kind of got it into the shape that, frankly, public market investors were really excited to see from a cost structure perspective. What takeaways do you share with your other portfolio companies with what Dropbox did in terms of refining its business strategy?
It's been a decade in the making. And so one of the unique things about Dropbox is they architected both an incredible business model and a wonderful product from the early days, but they've built something of tremendous scale. So Dropbox stores over 400 billion pieces of content. And so that has taken a lot of financial investment over the years, but that investment has paid off in a company that's been cash flow positive for a couple of years.
Not all companies exit. IPOs are what? We get 20, 30 a year from the tech sector here in the US, and there are a lot more private startups out there that have valuations in the billions. What specifically about Dropbox do you think made it a company that could actually get public?
Dropbox combines the best of both worlds, and what I mean by that is they have the strength of a consumer company, which is scale and virality of adoption, but they also have this recurring business model of a software company. There really isn't another business out there like it. The other elements are that it was both a great business from the beginning in addition to a great product, which is a hard thing to do. You know, if you were to partner with one or two companies a year, as we do at Sequoia as an individual investor, it's a once-a-decade thing to find two people like this who can pair both business and product.
What are you telling those other CEOs that you work with when you point to Dropbox? What are you telling them to take away from this narrative?
I think that Dropbox is a model of a long-term orientation to building a business. So Dropbox did announce a year ago that they're the fastest company in the SaaS space to achieve $1 billion in revenue, but it's taken a lot of time. And that means making the right decisions every step along the way. I think number one is building a world-class team. And for Dropbox, a world-class team means people who are the best in the world of their jobs, of course, but it also means finding people of tremendous character. And so the character of Dropbox starts with Drew and Arash, and then hire number one all the way up to Dropbox for number 2,000 today, and that's why it's been such a great privilege to work with them.
When I think back to 2015 when, say, Square listed, there was a lot of kerfuffle about the fact that it was going public at a valuation well under the private valuation. Talking to people these last 3 years in the IPO and the Silicon Valley worlds, it seems like some of that concern about a valuation haircut has been taken off the table. Dropbox price just under, it's now trading through above its private valuation. When you think about this valuation question, yes, it doesn't impact business strategy, but it does impact morale and potentially customer relationships or fundraising. How have things changed in terms of how people think about the change in valuation at IPO?
Well, at Dropbox, we've always focused investors, employees, anyone around the company on the very long term. And we felt that if we were building a service of value for 500 million people and over 10 million paying customers, that we would weather any ups and downs in the market. And I think what we've seen today is that despite a week of tremendous volatility in the public stock markets, a company that is built to last can just punch through all of that.
You're an early stage guy. You look at the companies when they are young, like when you got involved with Dropbox. Where else are you looking these days? You've got a pretty nice stake here, upwards of, what, $2 billion at the IPO price and trading higher. Where is Sequoia looking to put its money these days?
For Sequoia, there are tremendous number of opportunities today. In fact, in the last couple of years, we've invested in everything from rockets to data science to social media. But the honest answer and like the secret of venture capital is that we're looking for the next Drew and Arash. It's those founders that make the difference, and they're so hard to find.
And Drew and Arash, when do you look for that female pair of founders? How has your investment thesis changed given kind of the real impact that some of the strong female voices have had, talking about some of the systemic sexism in the Silicon Valley industry?
Oh, it's changing, and I think for the better. We have a long way to go across the industry. Actually, the last 2 founders that I've backed are female founders, so I'm glad you asked. And I think things are getting better, but we have a long way to go.
When you think about exit strategy here for Sequoia's portfolio companies, where are your thoughts these days? The market has run up. We have seen a little bit of a rout in tech stocks in the public markets, but it's been a long time bull market generally. Are things getting frothy? Is now the time to push your companies to exit? How do you think about your exit strategy?
Well, our strategy at Sequoia is actually to be the idea partner to the IPO partner to Beyond. And so we don't actually optimize for exits. And that's one of the ways that we think differently from other investors. We believe the exits will come if you're building enduring value, because that is what's attractive to acquirers or public market investors.